Most people say they want to invest in stocks, but what they usually don't realize is that there are two very different ways stocks actually make you money. Some stocks pay you cash, others don't pay you anything at all during the first few years. And that difference changes how you invest, how you feel, and how you react when the market moves. Before we talk about dividend stocks versus growth stocks, let's start with one simple idea. When you buy a stock, you're buying a small piece of a business. If that business makes money, you as a shareholder can benefit. The question is, how? Some companies choose to share their profits with shareholders. These are called dividend stocks. When a company pays a dividend, it means part of the profit is sent directly to you in cash, usually every few months or once a year. You don't need to sell your shares to get paid. As long as you own the stock, the money shows up in your account. Dividend-paying companies are usually businesses that are already mature. They rarely give you 100% or 200% growth, but they make stable and predictable profits. Think of banks, utilities, or property-related companies. They're not exciting, but they're reliable. Instead of trying to expand aggressively, they reward investors by paying them regularly. In a way, dividend stocks feel like owning a rental property. You may not sell the property for years, but rent still comes in. The value might move up and down, but the cash flow gives you confidence and patience. Now, growth stocks work very differently. Growth companies usually don't pay dividends at all, or they pay very little. That doesn't mean that they're bad companies. In fact, many of them are excellent businesses. They simply choose to reinvest all of their profits back into the company to grow faster. These companies use their money to hire more people, build new products, enter new markets, or scale their operations. Because of that, investors don't make money from cash payments. They make money when the company becomes more valuable over time and the share price goes up. Growth stocks are like planting a tree. You don't get the fruits immediately. In fact, for years, you get nothing. But if the tree grows strong and tall, the value later on can be much higher than what you started with. So here's the simplest way to think about it. Dividend stocks pay you now, growth stocks pay you later. To make this more real, let's talk about two friends, Ali and Hock. Back in 2016, both of them invested 10,000 ringgit. Ali invested his money in a property REIT. This REIT owns buildings and collects rent. Every year, part of that rent is paid out to investors as dividends. Ali receives about 500 ringgit in cash each year. The price of the REIT moves up and down a little, but the dividends keep coming. Hock, on the other hand, invested his 10,000 ringgit in a fast-growing tech company. It makes smartphones and later expands into AI and robotics. This company doesn't pay dividends at all. Every ringgit it earns is used to grow the business. In the early years, Hock's investment grows fast. His 10,000 ringgit became 14,000 ringgit. Then a bad year hits, and the stock drops to 5,000 ringgit. He receives no cash and has to sit through all the ups and downs. Ali's REIT also dropped slightly that time, but the rent is still collected. Ali still receives his 500 ringgit that year. By 2026, both investments have worked. Ali's REIT is worth around 13,000 ringgit, and over 10 years, he has collected about 5,000 ringgits in dividends. His journey was slow and steady. Hock's tech stock is now worth around 22,000. He made more money, but the ride was much rougher. Ali was paid to wait, Hock was rewarded for waiting. And that's the difference between dividend stocks and growth stocks. The mistake many people make is not understanding the difference before they invest. They buy growth stocks but expect dividend-like stability. Or they buy dividend stocks and get frustrated when prices don't move as much. Once you understand how a stock is supposed to make you money, investing becomes much less confusing and much less emotional. Stocks don't just grow wealth, they test your patience, your expectations, and your mindset. Hit the like and subscribe button if you like this type of video.